Today, we are cracking open one of the most important and maybe most misunderstood documents you will ever sign. Yep, we're talking about your loan agreement. You might think the deal is done when you get the keys, but nope. The real story, the one that can affect you for years, is hiding right there in the fine print. So let's go find out what it really says. All right, just imagine this. After searching for weeks, maybe months, you finally found it. The one. It could be a house, a car, whatever. That feeling hits you, you're ready to go. You're ready to make it yours. And getting the money? It feels almost too easy, right? You just pull out your phone, tap through this super slick app, upload a couple of things, and boom, approved. On the surface, it all feels incredibly simple, like ordering a pizza. So you scroll, you initial here, you initial there, and then you hit that big, friendly button, I agree. But let's pause for a second. In that single click, what did you actually commit to? What rule book did you just agree to live by for the next 5, 10, or maybe even 30 years? That's the real mystery we're diving into today. Okay, so first, let's talk about that simple facade. How is it that the experience on your phone feels so completely different from that giant stack of paper you end up signing at the end? Well, this pretty much says it all. You're living on the right side with the clean, easy-to-use app. But your lender, they live on the left. For them, it's not just a loan. It's a really complex financial instrument, a product that has to be legally perfect so it can be structured, secured, and maybe even sold into a huge financial market. And that brings us to the million-dollar question, right? If the app is so user-friendly, why does the process end with a document that could double as a doorstop? It's because your simple little loan is being pulled and shaped by two incredibly powerful and mostly invisible forces. So let's talk about those forces. We're stepping into a massive, heavily regulated world. And it's the sheer scale of the market, plus this huge web of government rules, that creates all that paperwork. First up, let's talk about scale. Just to put this in perspective, in 2021, the market for syndicated loans in the US, that's just one part of the lending world, was worth $2.9 trillion. Trillion! When you're dealing with that much money, you can't just have a handshake deal. Every I has to be dotted. Every T has to be crossed. It's an industrial scale process. The second huge force is regulation. You know, a lot of that dense legal language actually comes from laws like Regulation Z, which you might know as the Truth in Lending Act. Now, these rules basically force lenders to disclose everything, every fee, every calculation, every possible outcome. So while it feels like a lot to read, you got to remember, a huge chunk of that complexity is actually there to protect you. Okay, so now we know why it's so long. But let's try to make it less intimidating. We're going to give you a kind of roadmap, a way to break this thing down so you can find what really truly matters to you. You know, legal experts say you can break down almost any loan agreement into these 4 basic parts. First, you've got the definitions, the glossary for all the legal speak. Then the mechanicals. That's the simple stuff, how much you're borrowing and how you're going to pay it back. Third, you get the really specific stuff, the rules and promises for your deal. And finally, the boilerplate, the standard legal clauses that are in almost every contract. See? When you break it down like that, it's not quite as scary. Now, let's zoom in on what is, for you, the borrower, the absolute most critical part of this whole document. We're talking about the promises you make. And these promises really come in 2 different flavors. On one hand, you have representations and warranties. Think of these as a snapshot. You're swearing that certain things about your financial life are true at that exact moment you sign. But then you have covenants. These are promises about the future. They're about what you will and won't do for the entire life of the loan. So, what happens if you break one of those promises? Well, the Loan Syndications and Trading Association, a major industry group, puts it pretty bluntly. They say breaking a promise can trigger what's called an event of default, which, well, it can lead to a real parade of horribles. And what exactly is in this parade of horribles? Well, if you default, the lender can demand you pay back the entire loan, right now. They can slap you with penalty interest rates and fees. And maybe the scariest one of all, it can trigger a cross default. That means defaulting on this loan could cause your other debts, your car loan, your credit cards to also go into default all at once. It's a dangerous domino effect. But what if you do everything right? You make every payment on time, you follow all the rules, you're in the clear, right? Well, maybe not. Our last section reveals a pretty shocking twist for when closed doesn't actually mean the story is over. You have to hear this story from a user on Reddit. They said, "Fun story," and you can hear the sarcasm. "A couple of months after the fact, we got a call. Turns out the lawyer handling their closing made a math error. They actually owed a couple $1,000s more, and because of a clause they'd signed, they were on the hook for it." And this is that clause. It's called the Errors and Omissions Clause, and it's buried in the boilerplate of most agreements. It basically says you promise to help fix any clerical mistakes that the lender or their team made, even long after you think the deal is done. It means you're obligated to show up, sign more papers, and correct their mistakes. It's a real gotcha. So, as we wrap up here, it becomes pretty clear that your loan agreement isn't just some final hurdle you have to clear to get what you want. It's not a one-and-done kind of thing. You should really think of it like this. It's the official rule book. It governs one of the biggest and longest financial relationships you'll probably ever have. It lays out all the promises you've made, all the power the lender has, and all the rules of the game for years, maybe even decades to come. Knowing what's really hidden inside that document, from the clauses that protect you to the promises that can trap you, that's power. So the real question is, the next time you're faced with that stack of paper, are you going to look at the fine print a little differently? Thanks for joining us.